This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Tom DeMark. Tom is a market timer. Tom has a wealth of experience, 40 plus years on Wall Street. He's worked with some of the best traders that anyone has seen in the last 3 to 4 decades, from George Soros to Michael Steinhardt to Paul Tudor Jones to Steve Cohen. A really great conversation to look at how someone who has had so much success, to see how they think. And Tom's very upfront about it. He's obsessive. He loves what he does. He's very conversational. So if there's some aspect of our conversation where you don't feel like, wow, that sounded like a piece of jargon that I don't understand, well, sure, that could be true. Tom has put a lot of words in print. So if there is anything in our conversation that strikes you as, well, I didn't quite understand that, go investigate. Check out a Tom DeMark book. Dig in. Study. No one hands you everything for free, but Tom does do a great service in passing along some of his insights from his many decades on Wall Street. I hope you enjoy this conversation. But here's where I want to jump right in, because I saw this in a comment of yours, and you were essentially saying that all conceivable market factors are in the price movement. That's a fair view of yours, right?
Yes, it is. I think everything is bottom line price.
When did you first come to that realization, and how did it happen?
How did it happen? Let me think. I had always misperceived or misconceived notions back in the late 60s when I began following the markets. And there really were no technicians back then. I don't consider myself a technician, by the way, more a market timer. But I followed the markets, and back then, Gene Inger, I don't know if you know him, Gene Inger and Richard Ney and people like that were on financial TV. It just started in Chicago, and they had all these excuses. Well, Richard Ney in particular, he was a firm believer that specialists controlled the markets. So I guess for lack of knowledge, I went along with what he said, and there were other people as well. I mean, even Ira Epstein was starting up back then, and all these people would pontificate. Not saying that they're bad. What they did was wrong. I mean, they were obviously comfortable with what they were forecasting and the reasons or excuses for why the market behaved the way it did. I just accepted it, and it just seemed, even back then, occasionally a guy. Bill O'Neill appeared. He was starting a mutual fund at the time, and I thought, Jesus, guy's a mutual fund, and there was, you had the few mutual funds back then. I can't even think of their name. The Chinese guy, Jerry Tsai, and some others, and they occasionally would appear on TV, but there was really no broadcasting of their ideas. What you had to do is cull it from public information a little bit that was available then, and they gave all these reasons why markets are going up and down. Sometimes right, sometimes wrong. Most were long term. But so I started trading, and my few experiences were, they weren't bad ones, but I couldn't glean anything from what they were saying and be satisfied that the market would respond. At the time, that short term, everything was short term with me. I think I was just starting law school at that time, and I was looking for immediate response, and I just wasn't seeing it. So what I tried to do was, gather as much information as possible from other sources, but nothing was around. And by luck, when I was working at summer job, legal help or something, one of the guys there had Abe Cohen's point and figure chart service, and he also had Bill Giler's trendline service. So I got introduced to the technical side back then, and I was pretty open-minded, and I spent a lot of time, became obsessive, and then started...
what's your definition of obsessive?
Oh, geez. I think if you knew me at 7 days a week, even now after 44 years, 7 days a week, 24 hours a day. I don't know if you read any biographies about me. I was on there was a feature in Bloomberg last December. I mean, there are a lot of them, in fact, in Bloomberg, and there was Trader Monthly and, other people, the active trader. They've written him, and they all say he's obsessive, which I am. I'm one-dimensional. I have no life. I mean, it's wife and family do. I mean, they'll travel to Maui a month a year, and,
Yeah, but you love what you do, though, right?
Oh, yeah, that's all I do. I mean, I wouldn't be doing it otherwise.
I just don't want to let you say obsessive in a negative way. It's obsessive in a positive way, right?
Oh yeah, it's positive. Well, yeah. I mean, it's negative to people around me, but to me, it's positive. I mean, I'm one-dimensional. I have no life.
Well, I interrupted you where you were going with some of the light bulb moment.
Sometimes I have no idea, Michael. I gave a presentation at the event, and the room was full. It was standing room, only 200 people, but it was supposed to be an hour, and it went on for 2.5, and they got upset with me because there was no one, unfortunately, behind me, but they're conflicting, sessions, after an hour in other rooms, and some people weren't going, So I just kept talking. They were asking questions about Wilder and all these people because one way or another I've been associated with them. And the term obsessive, you asked me about that. From my perspective, I consider it. Well, I don't want to consider it an affliction or disease or whatever else, but it's been a passion. I think Peter Borsch will tell you that too. It was for him back then when we worked together. But like I said, I'm too into myself and my work, and sometimes it's at the detriment of the family, and people around me, which is not good. It's not healthy.
Well, let me take it back to you though, because I know I interrupted you there, but when I brought up the obsessive aspect, but you were going to go to where you had. I think you were leading.
Oh yeah, where I first got introduced.
To being baked into the price.
Yeah, the thing is, so I was fortunate in the sense I broke my back in law school, so I dropped out. Then I went to get my MBA, and I always wanted a job. I mean, I had 3 goals when I first started in the business. One was to work for, really 4 goals, to work for a successful investment fund. And then to work with Steinhardt, Fine and Berkowitz, that just started up, like Steinhardt's hedge fund, to work with Steinhardt, Fine and Berkowitz. And then, because of Richard Name, people like that, to work with a specialist firm. And then, just to be successful in whatever aspect of the business I was involved in. Well, I was fortunate. I got my MBA and then went searching for a job. I was thinking Chicago, Continental Bank, or Northern Trust. And instead, I was in Milwaukee. That's my area where I grew up. There was an investment fund that was investment subsidiary affiliated with an insurance company. And I was directed there quite by accident. I mean, there was First Wisconsin, M&I Bank, and places like that I could have pursued, but I went to this investment fund, and they had about $300 million. They were managing the assets of the insurance company, and there were only 4 or 5 professionals. And they all had CPAs, MBAs, and law degrees, everyone, combinations of them. And the president I was impressed with because at the time he was setting up the CFA, Chartered Financial Analyst, the program in Charlottesville, and he had just turned down a position to be the 4th partner in DLJ, Donaldson, Lufkin, Jenrette. It was going to be Johnson, and he was from my hometown. And I really thought that guy was great. I mean, he was president of the student body at the University of Wisconsin at one time. He was 20 years older than I was. But he was somewhat partial to me as opposed to other candidates because I was from his hometown. And he saw that I had a passion for the market, so he hired me. And then he made me a fundamental analyst. And it was a small group, like I said, and my immediate boss was a pure fundamentalist. And the president was pretty open-minded, but there were 2 other people there that were technicians, and they were more closet technicians. And both of them had law degrees, and they were one was a CPA, the other one was MBA. And they had trend lines, but they hit them underneath their blotter, and they did relate to the other people in the company. And another guy was a pretty well-known economist, and we opened our meetings with some market forecasts and things like that. And I had already been somewhat exposed with, point figure, which I don't. And then they told me to sign up for the Wyckoff course. I was in Illinois, so it wasn't too far from us. I went to see the people there. And so they said, look, the market had made a bottom in 1970, and I joined shortly afterwards. We got to the 1973 peak, and the work I had been exposed to technical analysis. I was getting into it more and more, and the two guys who were there, I was exceeding their knowledge because I was really into it, and it finally got to the point where I was starting to look amongst the Wall Street people, and I met Ralph Enkelpour at the time and Alan Shaw, who were at Smith Barney, and Ralph had just left the seminary, in fact, and got married to a opera singer. And I liked Ralph a lot. And I was meeting the other Wall Street people, but the problem was they all spoke the same language. It was trend lines, moving average, Bob Farrell and Dick McCabe at Merrill Lynch, and they all spoke the same language. And it was more on the sales side. They were all great technicians in their own right, but they didn't have much depth. It was sentiment indicators, odd lot short sales, Coppet, the Coppet was the odd lot group. They tallied up the figures, they posted them in Barron's, and the sentiment was not really reliable. So I said there's got to be more to it. So I started searching out and outside, and I did because our company avoided the 1973-74 crash. We grew from $300 million, and we were the first company to accept outside funds, outside the insurance company. We accepted pension and profit sharing plans. And right away we got Eastern Airlines, Reynolds Tobacco, and state of Virginia, places like that just decided they were getting into the pension business, which in retrospect was a mistake for all of them now, but they got in, and we were getting all this money because we avoided the 73 crash, and then when we got 74 crash, by 1975, we accumulated about $6 billion. And we were on the cover, institutional investor and everything else. And some of the work that I did, I can't lay claim to it. The result of success were indicators that I was creating at the time together with their knowledge. And our clients didn't know that we were using more and more market timing and technical analysis, whatever. But we were able to relate to them in terms of fundamentals because our president was CFA, and I would have been CFA grandfathered when I started, but I turned it down. I said, I'll take the exams. They were just starting exams. So I took the C and F, but I decided never to take the A exam because I wasn't a pure fundamentalist. Despite the fact I think all markets are driven by fundamentals long term, but it's a question of when is the timing right? When to enter the market and exit the market, and that's all determined by psychology, and that's all price, getting back to what you asked.
No. Yeah, I want to interject one thing there. You mentioned the idea that clients at the time were more preoccupied with fundamental analysis.
Sure.
And a lot of your work was started to be more technical. I still think today that there is a certain number of either technical or trend type guys, quant guys, that still, I think, have the, quote, cover story of fundamentals, but I think a lot of their shops are still driven by the technicals, even though their clients still might not understand. I don't know how much that's really changed in 40 years in some ways.
Well, I think there's first of all, a bear market will make everybody open-minded. Right now, when the market's going up, everybody's a fundamentalist.
Yeah.
And everybody, in the background thinks that they're right, and their timing is right because everyone's timing is correct, But back then, it was like I described at the time in some of the interviews I had, it's like having a monk in a monastery having a Playboy magazine and having to hide it, And that's the way it was. You didn't tell people you were technicians. There was a bad connotation to it.
What was the typical reaction if they heard it? Just that you're just.
Well, there were a few people like at Minnesota Mining. This is later in the 70s. They went ahead with me as a consultant at the company. I set up a subsidiary to be a consultant consulting clients, with George Soros when he first started, and Quantum Fund and things, places like that. Because I made a reputation on buyouts, and I made a reputation, like 32 buyouts before they were announced, and it was all legal. They were back in the late 70s, early 80s when you had the purge with Milken and people like that, Princeton, Newport Partners, and.
Hold on. You've got a 40-year career, and apparently, as far as I can tell, and doing my homework tonight, you have either talked to or worked with just about everybody on Wall Street. So I can tell you right now, your memory is going to far exceed most people's.
No, but see, that's what Gerald Jobman, who wrote a book, said I was the Forrest Gump of the industry. of the investment industry. Just the associations, and I've been fortunate in that respect. Yeah, I really have. The thing, I think Larry stayed here 2 weeks ago with his wife for 3-4 days, and he's having some misgivings. Obviously, he was in the retail side of the business, and he was influential in my career in the sense that in 1973. I got to know Larry because you were asking about, we're going back to price, and I'll think of all these things too in the meantime.
Well, I
met Larry.
Go ahead. Go ahead. I'm sorry.
I mean, is this supposed to be an interview where people are going to hear the conversation? They're going to be all over the.
No, listen. Here's the thing. I generally let everybody hear everything because people love this. They love because what happens is when you start talking, I think the audience, they hear some nugget. There's something, a tone or an element or a story, and people relate to that and they love it. So you're thinking of a zillion things in your head, but for a lot of people that are new or starting out or they don't have the experience, it's just gleaning something from someone that's been there. They just love that.
At the time, you asked me, going back to this price question you had, we, in 1973, approximately, I got introduced to Elliott Wave at that time, too, or 72. I was reading Bank Credit Analyst, which was written by, or at least the editor, Tony Beck. And it was, the publication was either out of Bahamas or Toronto. They had two offices. And I remember I called him back at the time and said, I read your economic forecast, and very interesting, and I was particularly interested in a mention there of Elliott and by Hamilton Bolton. Hamilton said, "Your staff, is he around?" He said, "No, he passed away." And I said, "I'm interested in learning as much as possible." And he said, "I really don't know much about it, but you might want to call a traveling tax judge in Canada." I said, "Sure," because we had the resources, and we could invite people in, pay their way or whatever. So I called this guy, and it was October, November, and I said, the guy's name was Jack Frost, and I said to him, "Hey, Jack, Tom DeMark calling." He says, "You're a Yankee." No, I said to him first, Jack Frost. I said, "You're painting the leaves up there," being not sarcastic, but just joking with him. And he wasn't open to jokes. He says, "You must be a Yankee." I said, "Yeah." And he didn't appreciate my comment, be called Jack Frost. And he said, "I don't have time to talk about it, but I can give you two people who were considered authorities on Elliott Wave." So I said, "Okay, tell me, give me their names." And one was a doctor in Wildwood, Florida. Another one was a doctor in Merritt Island, Florida. So I called the doctor in Wildwood, Florida, and I told the guys in my office, I said, they knew how obsessive I was. They said, "Look, do as much outside research as you can, work, and let us know if anything's worthwhile." When I talked to the doctor, he was all excited because I was interested in Elliott Wave. And he said, "Look, I'll come up and give you a presentation." I said, "Well, we'll pay for it." And he said, "We'll pay for your accommodations." He said, "I can only come on Friday." I said, "It'd be better during the week because all the professional staff, and I want them to hear it." He said, "Well, that's it." So I went back to the staff, and I only been there 2 years. And I said, "Look, this guy seems to really be an expert in Elliott Wave." They didn't know what I was talking about. They said, "Well, we'll give it a try." But he said, "We got social obligations on Friday. When's he coming in?" I said, "I got to pick him up 4:30 or 5 o'clock. I can't remember, at the airport." And they said they canceled their social commitments. And we were in the conference. They were waiting in the conference room. I went to the airport to pick them up. And I remember, this is the first experience I had, and this was really got me moving in my own direction. I went to the airport, walked up and down the concourse to the gate. Everyone deplaned, and I didn't see Dr. Wiley, that guy's name. So I went to the phone booth, called his office, and a nurse or assistant or somebody answered the phone. And I said, "I'm calling. I'm supposed to pick up the doctor. This is going to be embarrassing. I'm supposed to have him at a meeting, and he's not here." And the woman, whoever she was, said, "Well, he'll find you." And I said, "Okay." I was in the concourse walking back and forth, nervous, and this guy comes up to me with a big, long, white beard, and he pointed his finger at me. He said, "You're Tom DeMark." I said, "Yeah." And he said, "You know how I know?" I said, "No." He said, "You're walking at Fibonacci angles." Well, I didn't know what Fibonacci was, but I knew it was related to Elliott. And I thought, my God, this is the guy I got to bring back to the professional. I brought him back, and to the office, and he brought out loose leaf folders, and he went back to, I didn't even know if the markets existed back then, to the late 1770s. He had a Dow Jones average he claimed, and he was going through the Fibonacci series, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 377, and on and on. And he said, here's my Fibonacci wave. I mean, it was embarrassing. And I got stuck with the guy. So the following Monday, I thought either I get fired or, get put into a holding cell or something with the guys. And they said to me, look, be more circumspect in the future. We know you're really into it. You think everybody's an authority. A lot of these people are quacks. On our side of the business, institutional, we didn't run into that. On the retail side, there were some. So what I did, I was really intrigued by it. I called the other doctor in Merritt Island, Florida, shortly afterwards. And I remember I talked to his nurse, and I said, doctor there? And she said, he's busy right now. What's it regarding? I said, Fibonacci. So I was pretty proficient in Fibonacci by then. And I said, Fibonacci numbers and Elliott. And the guy got on the phone, the doctor did. And I said, doctor, I'm really interested. And he says, I know it backwards, forward, inside out. He said, I've been married 5 times, and I have 8 children, and every 13 days I take a vacation. So I knew that I was on the edge of the dark side right there. And I said, from now on, I'm going to do my own work. But I was fascinated. I was able to buy all the books in the public domain. And I was going back. I mean, Tubbs' original courses, Henry Wheeler Chase, the Wyckoff course. I mean, there was one after another. And I started contacting people like Gann's family. And I was learning that a lot of these things that people believe nowadays, like so-and-so Gann was multi-zillionaire. And I mean, someone committed suicide, like Livermore, and other people were locked up in holding cells, were locked up in institutions, and things like that. And there's all this market folklore. And, Larry could probably tell you better than I can because he's familiar with this. And so I said, this is nuts. I got all the books and I was reading them. There was one group of books by a guy named Flumiani on Elliott Wave. It was just, my wife, I got married shortly afterwards. She was just upset by the cover of the book. It was just freaky. I have a library. It's huge. And it was really, really the dark side. Some of these people were so obsessed. It was, almost like Poe in his writings. So I did find one book that was good, The Secret Stock Market Selection and things. I think that was the title of it. And it was Larry Williams. So I contacted Larry. And at the time, like I said, there was a shortage of people. But there were people out there that were creative. And Larry was the guy. He really was. And I think Larry...
So a lot of your original inspiration while you were searching and investigating and meeting with people, and some, as you say, were quacks, meeting Larry was a turning point.
It was a turning point. Yeah, my wife said the same thing in retrospect, too. I mean, he's got a lot of skills. And, I can't say enough about him. He's a very, very good person. I mean, when you first meet people like that, you're brought up, you go to carnivals, places like that, and the guys who are the heaviest marketers are generally the people to be wary of. And Larry was not a marketer at the time, but he was so confident. And I could tell that what he was doing, he believed in. And that's hard to find. But you can sense sometimes when people are trying to sell you something and they really don't have conviction. But he did, and he's full of ideas and everything else. So he and I, hit it off pretty well, and a lot of respect for him. He would conduct seminars. He'd attract, 1,500, 2,000 people. I mean, it's unheard of nowadays. Mm. There were people who tried to imitate him. J.L. Patterson came out with things, Cybercast or something, late 70s, early 80s. Charles Lindsay. There were people like that who came out with seminars. None of them were Larry. And I just respected the guy. Now, because he was retail, oftentimes you couldn't talk about him to the institutional side. And if they saw anybody who was getting a lot of publicity on the retail side, they shunned him. And they thought, okay, these guys are just promoters. In his case, he was an exception. And like I said, in the mid-70s, mid to late 70s, I don't want to say we uncovered him, but we found Joe Granville. And the reason I was focusing on those two people, they're all price-driven. Larry created an approach called accumulation distribution. And what he did was unique. He used opening prices. Now, Joe Granville used the comparison of close to close for unbalanced volume. So the two of them were on the same path. I mean, there were some predecessors who did, did some pioneering work in that area, but Joe had the unbalanced volume and Larry had accumulation distribution. So I respected both of them. And that's where I was, and that's how that approach, I mean, it's a little different. Joe would compare closed as closed from one day to the next and assign volume to it and run a cumulative index. Larry would use the relationship between open and close, and he would assign an index and compare price movement versus that index, just like Joe did. I used both approaches somewhat, but I took it quite a bit further. Whereas Larry would use close minus open, I use close minus open divided by high minus low. So if you open on a low and close on a high, all the activity that day was buying, and conversely, if you open on a high and close on the low, all the activity was selling. And you'd run a cumulative index that way, but that still wasn't enough. I wanted to know when the buying and selling were going to, really translate into a price movement. So what I did was take close minus open divided by high minus low, and I would segregate all the positive days, the days in which the close is above the open. Say there's 13-day index. I would take all the days close minus open divided by high minus low times volume, add up all the buying pressure days, and then divide it by the absolute value of buying pressure plus selling pressure. And that way I get a ratio of buying pressure. And then once I got that, I would run an index, 13-day index, but I'd run 13, 55, and 89. And once those all became overbought or oversold, that would be a leading indicator. And then I would break it down further, and you would see, and that's when I really came to, I thought, a conclusion that was pretty important. This had to be around 1974, 75, that markets bottom not on good news, markets bottom on bad news. So it's really contradictory when the market's declining, and my whole thesis has been, and people have kind of latched onto it. A lot of people say trend is your friend. I came up with the trend is your friend unless the trend is about to end.
Yeah, I made that note here that I was going to bring that up with you.
Yeah, well, see, here's the reason for it. Markets make bottoms not because of smart buyers. It's because, figuratively speaking, the last dumb seller is sold, and there's a vacuum. And markets go up initially, and that's what I was saying with this close minus open, taking the divided by high minus low, you can get a ratio, like a 13-day ratio, a 5-day ratio, and you'll see at market bottoms that the markets bottom because of the absence of selling. It's not because of buying. If there's buying, it's usually short covering. And then markets top, not because of an absence of, sellers at the peak. It's an absence of buying. So I'm a firm believer that each market, and more so now than ever, industry groups, I mean, they're specialists in stocks, and not specialists in the sense on the floor of the exchange. They're specialists in stocks who are really experts, fundamental experts. And it's almost a contained universe of traders or investors in different markets or industries. And they're obviously the funds that they have available are exhaustive, either on the upside or downside. And unless you're able to change the fundamentals so dramatically, their upside or downside, to invite other groups or other individuals, groups, whatever, into that closed, what was at the time closed group, you're not going to affect the market dynamics such that when the market exhausts itself of buyers, it's not going to top. The only thing that's going to change that to continue to resume the trend upside is for the market to move sideways, and then new people to be involved in the market who have forecasts that are fundamentally greater than the participants. And that didn't happen. It was like a closed community. Because I remember back in 1974, before May Day, high volume day was 10 million shares. I remember we used to close down on Wednesdays. I was really obsessed with the market so much that I was upset. Weekends and then Wednesdays when the back office was closed because markets did more than 10 million shares. So you had a contained trading or investing group, and you were able to really identify exhaustion of trends prior to their occurrence. Back then, easier than now, and especially now, with the interference of central banks and governments, it's near impossible for. Let
me as you bring today up, I did notice in preparing to talk with you tonight that, and I had seen some of the headlines in the last 30 or so days that you've made some news with some comments in the last 30 days. And I want to be careful about how I ask this, because I'm not asking you to lay out some opportunity for people to go act on, but you had come out and you made some public announcements that your work, your research was showing you some rather bearish views on USA equities. And I don't know, maybe this is a perfect time to kind of take it from early in your career to current day.
Okay, I can go back, I guess. I'm jumping from one topic to another, I guess. But just to put some context in it, there have been times when the markets have identified exhaustion with what I consider 13s or even 9s. The comparisons, and markets have topped. And sometimes, I've been spoiled because it's been the exact day of high and low. And those markets, I feel the rhythm of that market is pretty well identified with the cadence that I created back in identified in the 70s, that markets behave such and such. And that I found out, originally I created this using trendline chart books and Victoria Feed chart books, which were commodity. They're huge ones, and Wyckoff charts, as well as, Bill O'Neill, Daily Graph, Data Graphs, all those chart services. I was using a magnifying glass, and this all predated bull market calculators, and all I used was a slide rule and a ruler, and TI 57 magnetic strips didn't even exist then. But I was poring over all these comparisons. And I found that markets, even back 1929, 1970 low, 74 low, the peaks, interim peaks and everything else, had 13s. And those 13s were pretty significant. And I thought, geez, I uncovered something that's existed forever, and has application concurrently, which is unusual. Usually you can optimize and find something that's very, effective. When we learned, because you had all these rules, and all you did was price fit. So it was in a sense, it allowed me to be proactive and rather than reactive. And what happened, just to give you a recent series of examples, you can see them in the press too, because it was on the front page of the Shanghai paper. In fact, I think my picture was, or big bold headings. In December of this 2012, the day of the low, I got a 13 indication, which indicated the long-term downtrend of the Chinese Shanghai index had exhausted. And that day, in fact, problem is in China, they're a day ahead of us. And sometimes when I give some information to a reporter, it turns out that they're preparing the report after the close, but it shows up prior to our open. And that's bothersome sometimes, because they give you the impression that it was made, if they have the date, that it was made in U.S. day, but it wasn't. But regardless, that December low in 2012, I got the indication of exhaustion December 3rd. And the announcement was made after that day, so it turned out to be into trading on December 4th. And at that time I said, market is bottom, Shanghai index is bottom. It's going to go up, I think 48% I calculated. Well, then when the market, that was on December 3rd, it was published December 4th. And the market did rally. And it peaked, I think February 18th. Well, the high close was February 6th. On that day, I said, no, you're not going up 48%. We topped. It was 25%. The market's going down, and initially it's going to sell off to 11.2%. It could go deeper. Well, they stopped at 11.2%, and they said, that's it. Well, what happened, I said, when they contacted me, when the market had declined into the May low, late April low, I said, yeah, we're going to have a rally. We'll probably rally from 21, the low at that time was around 2160, and I said we'll probably go up just above 2325, and that's exactly what the market did. But I said this low is not the one to play. There'll be one in June. And the day of the low, if you look up and, like I said, you go and read the newspapers or whatever it was quoted everywhere, I guess, for a period of time, into the June 25th low, I was positive, and I said, that's it. That's the bottom. And there was a significant bottom. 2450 went down to 1850, and they came out with the bottom exactly the day of the low. So that, what happened, some of the guys at the office told me, and they told me as well, they sent me some reports from China. In fact, they called me the prophecy emperor, prophecy forecaster emperor, or something like that, because those 3 calls were right to the day. And then on September 12th,
but that's, you're not necessarily, as you say, they're right to the day. I mean, your work, exactly the day. There's a little bit of luck being right to the day, or you could have.
Oh, sure.
Yeah. You're just kind of using those as
I mean, there is. But here's what I'm getting at, and I'll get to it to the U.S. market after that. And then, if you look, exactly September 12th, the day of the high. So it turned out the 4 days, the low in December 4th or December 3rd, 2012, then the February 6th high for the day, there were exhaustion indications exactly those days. Mm. Now, the one in, I was quoted June 21st of this past year. It was a Friday. So it was after the close. No, that day, the editors, I think it was Bloomberg or Business Week or somewhere, said, look, I said, don't publish this for 2 more days, 2 more trading days. I said 2 more days, meaning trading days, because I said, we're not there yet. So what they did, they interpreted, I mean, a lot of the writers, are just writers. They're not familiar with the market. Well, I said 2 more days. Well, they said, and all of a sudden it came out Sunday night our time. And I said, well, this is wrong. I told you to wait until after the close Tuesday. That's the bottom on my work. And he said, well, you said 2 more days. And I said, 2 more trading days, I said. So it did turn out the way it was, I think it was the way it was written, it did align itself with June 25th, which is low. But it came out, all those 3 turns are right to the day. The one I thought was really good was the September 12th, right? The close, it was the high day. They published it that day. But what they did, they said DeMark Indicators said a top, and which I did say. But I said I usually don't give much credence to fundamentals because I try to be pure. But an indicator I've got, which is fundamental, says we could possibly ignore this because the pullback is going to be there. But ultimately, the market should go higher. Well, that was me speaking off the cuff fundamentally. So I wanted to qualify the 13 there, or the top there, and I wanted to be very emphatic because I didn't want the market to have a 5.56 or 11.2% correction and then come right back up without me producing, a 13 top or bottom in this case. So I tried to protect myself, and being too glib like that, I think was in retrospect, I should know better, because she took it, the writer did, as me saying, ignore the top that I'm seeing, which was that day, because the market's going to come back. And it has come back now, recently. But the fundamental indication I had was tentative, and I just wanted to qualify it, and I don't see that existing anymore.
You're talking about U.S. stocks?
No, I'm talking this is about China.
Okay, China.
This is all really about China. Now I'm going to the U.S. market. Okay. The U.S. market on October 4th, since the April 29th, 30th peak in 2011, at that high above 1364 on the S&P, I hit my price objective within 2 points. And I also had what I call, a sequential combo top and everything else, daily, weekly, monthly. And I said, from there, we're going to go down to 1076. So the market declined, as I thought it would, and hoped it would, I guess. Nothing's certain in this business. That was on the S&P cash. I usually follow futures, but that was a cash. And I said, the market's going to decline, and it's going to bottom at 1076. Well, in August of that year, after the market had declined from its peak, that was the peak, like I said. It was intraday. It was May 2nd, but the high was really April 29th or April 30th. I can't think what day that Friday was, but it topped there on a closing basis. I said it was going to go down to 1076. Well, I remember the low on August 9th. I was in London at the time, and I said, this is a low, but market's going to make a lower low. The market's going to rally. I mean, a low 1101. I said the market's going to rally to 1225. And the market made a low that day and went to 1225. I think it went 1230. And that was on the end of August 31st. And at that time I was interviewed, and I said, no, and it's all documented. I said, we're still going on to 1076. What happened, the market on October 3rd went down to 1074, I don't know exactly, 78, 77, something like that. It went down a point below where I forecast. And I went on TV at the time, and I said, it's the start of a major move upside. Market's going to rally. I said, first stop should be 1290. Well, it went 1290, but I thought it would take weeks It ended up taking, months, I should say. It ended up taking 4 or 5 weeks, and we were there. So then I said expected decline into Thanksgiving. And we're seeing the reverse of that right now, by the way. I said into Thanksgiving, and we saw a decline. The low was made Thanksgiving, and the market took off again. So I was able to call it on the S&P, just like at the March 9th low in 2009. I was able to call it low. Our work did. But just like in 2006 and even in 2009, off those lows, we got indications that the market had topped. And I thought, geez, this is strange. But at the time, and finally in 2010-11 on TV, I said, individual markets are conforming very well to the indicators, because I've created all these indicators. And I said, one thing about my indicators, they're all, 99% are exhaustion type indicators, and they complement one another. They don't contradict. But I said, off these lows, there's something strange happening here. And I think it was Adam Johnson or one of the people at Bloomberg on the air. I said, something strange happening. There's interference coming in the mirror. I said, the patterns that have existed forever, that are exhaustion patterns, there's something fundamental that's interfering with these and extending the moves on the upside, not the downside. And I said, I bet you central banks or the governments. And I got so much negative feedback on it. And all of a sudden, Israel came out and announced they're buying equities. Switzerland, I think, and Japan did as well. That all came out months later. And then the Federal Reserve, obviously, has been in the markets. So I got vindicated. I was making that forecast. And the reason, and I think I've had forecasts to the upside with price projections and everything else, and there have been interim highs when I've called, 1373, whatever the price, 1570, different projection levels. And what the market has done, it's either corrected for a couple of weeks and then gone right through those levels again. And I can see that's caused by interference. Now, if you take the components of those indices, or the index, you can see they behaved as they should. But the overall index has been influenced. I think we're at the point now, though, like where 1820 has been recalculated as of a couple of weeks ago. 1820 is a projection on the upside S&P cash. I would think there's formidable resistance up there, really big resistance. And we're moving into a period where the market's been up all. I don't want to get into a forecast because this is all, first, obviously educational. It's not recommendations, but we don't make any recommendations. But we're moving into, and there's generalizations as well, but I think there's a point when this interference is going to end. It's just going to end. And I think markets will start conforming. The indexes will at least be conforming, or indices will be conformed the way they should be. And we're approaching that point now. Now, obviously, some of the comments I've made to reporters.
To clarify for the audience, though, when you say indexes conforming the way they should be, you're talking. We're kind of talking like we're old friends, but what you're really saying is conforming to the studies and research and the
models I created.
Exactly. Okay. Just to clarify for everybody.
Yeah. Oh yeah. I'm not. Believe me, I'm old. I'm getting older, and I obviously got a lot of confidence in the work I created. I mean, it was just me that created it, and I have staff now too, and everything else. And I don't rely upon anything other than our work. So there's no excuse. I mean, in this industry, especially beginning traders, they have a tendency to blame other people. And I've always been of the belief 99% of people who trade or invest do so on a whim, or they look for something that'll justify whatever their predilection is regarding the market. And the 1% that's left, or those 99% of people rely upon the 1%. And 99% of the 1% are using tools that aren't reliable. I think it's a real finite group, I think, that have created things that are reliable, and have been time tested.
Let me shift. I want to shift slight gears on you. I want to do something here's where I'd like to go with this. I've got a couple names here. And you've had a chance to work with some really interesting people. And of course, a lot of those interactions are going to continue to be private. And there's only so many things you can say with either current or past clients. I understand all that. I'm not trying to probe there, but I'm wondering if I give you some names, if you might be willing to tell the audience, just from your perspective, perhaps, why that individual or something interesting about that individual and their success that you can tell the audience? So, for example, you mentioned early on George Soros and that you had come in contact with him, providing some services back early on. Yeah. What would you, if somebody was saying, Tom, you had a chance to, really meet so many different interesting people, what would you tell like the young college guy today? What's something interesting about George Soros that's really made him successful?
I think the big picture, he's got a profound understanding of the way governments and financial institutions operate. I mean, the guy really has a phenomenal grasp of the big picture. I didn't work as much with George. I mean, a few occasions I did. It was mostly his people. He has a great grasp on trends. He just does. I mean, but he's big picture. The people who work for him are the ones who really executed it, and they're more into the nitty gritty, fine tuning his forecasts. So I really can't speak to that, but I just know he started, when he started Quantum Fund, it was a small fund, and it's turned into something huge. And the guy is a great big picture analyst. That's the way I look at it. I was not as close to him as I've been to other people like Leon Cooperman.
Okay, let me move on to some of those other names then. So I know Michael Steinhardt, and for those that might not know, Michael Steinhardt, if you looked back in the 80s and early 90s when Wall Street top 100 list would come out, it was usually number 1 Soros and number 2 Steinhardt. So he was extremely successful.
Yeah, he had a great, he had an understanding how markets operate, down to the short term, and he had a lot of great research sources. And once again, I worked more closely with his people. He had specialists before this was common to do. I mean, he had a guy named George Henry who worked he was formerly with the Federal Reserve, and this is in the 70s, just when bond futures were being released in the mid 70s. And Mike had the foresight to hire him. I guess George was a close friend of his growing up, and he had great fundamentalists, great contacts, and he had a good understanding too, just like George Soros, of the theme. In the sense that the theme, there usually are concepts that drive markets over a long period of time, and he had that ability as well. But he was in the 70s. When I first started in the business, that was the group: Steinhardt, Fine, and Berkowitz, and Mike bought out the Steinhardt and Fine and ran the hedge fund. It was the predominant hedge fund at the time throughout the 70s, early 80s. Steinhardt.
Let me shift gears on you again because I've got a whole list of names here, Tom. So I know eventually in the mid to late 80s you joined with Paul Jones. And when Peter Borsch was there, in fact, I want you to comment on Paul, but what Peter said to make sure to ask you too is he said to ask you about the idea when you guys were first starting to computerize your indicators. But maybe I'll let you first talk about what might have set Paul Jones apart from your perspective.
Well, I met indirectly Paul from a fellow that was starting in the business at the time, and a fellow named Zach Bacon, his brother Lewis, runs Moore Capital. Zach was at Goldman Sachs in the bond area, and I met him. He became very interested in my work, and I had a relationship with him for a period of time, and he would be commuting during the summer to the Hamptons, or that area, and he would always ask me, "What do you know about cotton? Tell me this about cotton. Tell me that about cotton." And I never asked him why, but we would talk about cotton. And that was in the early 1980s, and finally he said, "Well, I've got a close friend who is setting up a fund. He's very experienced in the cotton markets at free trade," and he told me it was Paul Jones and Paul Tudor Jones. So the relationship with Zach was such that he wanted to leave and expand, and he said, "Can you help me out as a reference, possibly another firm?" And that's when recommended Soros. Lee Cooperman and I think were somewhat responsible for him taking a position at Soros, and that's my connection there as well. And during that time, I was frustrated because I was successful in a consulting business with a number of clients, and very successful, in fact. But I wasn't getting my chart books, and I was using Commodity Perspective, which the O'Connor Group created in Chicago, and the guy named Ray LaValle ran. And they were publishing these in Des Plaines, Illinois, and I wanted to pick up 20, 30 copies on a Friday, so I had to work on it over the weekend. And they were unwilling to give me the copies on a Friday. So I just said, hey guys, if you don't do it, I've got to do it myself. I'll collect my own data and create my own charting service. And they said, go ahead and do it. We just really can't accommodate you. You have to pick them up on Mondays. And back then, there was really no Federal Express or anything like that. It was special delivery, but you really didn't get timely turnaround. So I created my own chart books, and had a relationship with Cotron, which was, the Bloomberg or the old days, and I had all the data coming into my computers. I had the largest Hewlett Packard installation in the state of Wisconsin, and we got all the data from all the exchanges from Cotron. And in fact, I also got data from Fitch Services back in 1969, tick by tick, everything. I had the most exhaustive data source, I think, around. And fortunately, we lost it all about 6 years later. But had that, and I was working my own charts and everything. And then from there, I picked up Fundamental Governments, which FBI, they handle all the government data. I got all the data from First Boston and other sources and created a chart book there as well. Well, I had all those chart books, and I was working on things, and I was able to respond to Paul Jones's needs as well as other clients immediately. And I started appearing on TV thanks to Larry Williams. He was on Financial News Network, and he said, why don't you alternate with me week by week? And I got to know, Sue McMahon Herrera, she was great, and Bill Griffith, who's one of the funniest guys around, and Ron Insana. I got to know all three of them, and I was on the air and everything. And when I was appearing on the air, I would make forecasts based upon, back then you were allowed to do it, and make some forecasts, and I was making forecasts on some stocks as well, and that was licensed back then. And the forecasts were pretty timely. Teledyne was one where Henry Singleton was chairman, and I would talk to Lee Cooperman, who was a great fundamentalist, probably the best fundamentalist in history. And he was at Goldman Sachs at the time, and I would make forecasts like that. Well, I came out with a market letter as a result of Financial News Network. And that market letter, and Bruce Babcock's CTCR was number one for 3 years. Well, apparently what happened, Peter Borsch, who had left the Federal Reserve and was a whiz kid, I mean, he really was. He was 25, 26, 27 years old. He was Paul's right-hand man, and he was setting up a research department there. And he contacted me because he was receiving the market letter. And he said, why don't you come and visit, and we might be interested in doing something. And that's how that evolved. So I had a relationship with Tudor and became executive vice president. Peter and I worked closely together and got a great mind, and that's the relationship I have with Paul Jones.
What would you how would you if like, let's say the young 23-year-old recent grad is out there, they've read the Market Wizards book, and this guy Paul Jones sounds like a really, really sharp guy. And of course you can go look at the success. It's a matter of the public record. So, yeah. But if you were to kind of give a brief synopsis without violating any trust, what would you tell that young person about why Paul Jones has been successful?
Paul Jones was there at the right place at the right time. I mean, he had all the skills, and he had the Peter Borsch, who was his sidekick, and they were able to conquer the market. They caught the August 1987 high. Paul did it using analogs with Peter, and my work at the time produced a top as well at that peak, and they were using the analog, comparing it to 1929, which is a 55-day calendar decline into the low, which they identify as November 20th, and that decline that Peter and Paul forecast was responsible for a lot of publicity, and Paul was sharp enough to diversify out of commodities. I mean, he was in stock futures, and he got into equities and everything else. He's built the empire he's got now. Paul was very committed as well. What I found is most people who are successful in this business are not in the business to make money. They really have a passion for the business, and money is just a
way to keep
sideline. Yep, that's it. That's true. And, Paul was there, and I've met the others too, because, Lee Cooperman is probably the best fundamentalist. There's another fellow at Passport Capital, whom I got to know a number of years later, and very close friends with, John Burbank. He's a phenomenal fundamentalist. Those two are probably the best. I mean, Lee Cooperman and John Burbank, but, I guess they're the new generation Buffetts,
Well, so, and most recently too, and I know there's been some negative headlines, but I know one of your most recent clients has had a pretty outstanding track record for a long period of time. That'd be Steve Cohen. Yeah,
I mean, obviously for legal reasons and other reasons, just don't want to interfere and all the publicity and everything else. But what I can tell you, after 17, 18 years, the absolute best trader in history is Steve Cohen. Yeah. Absolute best. No one compares.
Well, and I think while you say that, and I appreciate you saying, given certain situations, as you say that, I think that's food for thought for the young person or the more established person out there, that they can go do their more homework. So by you making that statement, other people can go dig through and learn and investigate more, because I think, but when you say something as strong as that, given the current situation, you can't really elaborate, but I think that gives people, just like when you were talking about early on in your career, you were investigating and going down the path. I think it gives people at least a direction to go figure out more about the trading, and that might be a good angle for them.
Yeah, well, see, I've got some reservation in talking about it, but I can tell you unequivocally he is the absolute best, and he'll go down in history as being the absolute. I mean, just to give you a little context, I mean, obviously Barack Obama is being criticized for NSA, for IRS, for Benghazi, and all the other issues. And he probably didn't have any involvement. I mean, these are sidelines in his job. Same thing with Steve. I mean, there are people I know that he didn't even know that were accused of things. I mean, he's got 1,300 employees, 140 different profit groups, and it's tough. If you're the top dog, obviously you've got to take responsibility, but there's no way. I've seen, you talk about obsession and commitment to trading. I've never seen anybody like that, and as sharp as he is, nah.
Well, we'll leave it for the audience that wants to.
I think history will be right. History will be right. I mean, this year he's up 34% or something like that. But after fees, that's quite a bit less. But still, he's going to be the best.
Well, so let me follow up there. The one last question, as we were mentioning names, because I don't know if you want to kind of elaborate on it, but Peter brought it up with me, the idea that when you guys were first starting to computerize your indicators, there must be a story there that he was trying to lead you into.
I don't know. There are many stories, Peter. Peter was the youngest member of the Brady Commission. He was 27 years old. Yeah. And just think how important that was with the Secretary of Treasury. I mean, he was invited to be there. He's a prodigy. I mean, Peter is a special person. But what's special about him, he is totally familiar with my indicators, but he's also familiar with everything else in the public domain. But he's really well schooled because of his background in the Federal Reserve and at the University of Michigan in economics and everything else. He's fundamentally sound too. And I think the combination, I tell people that all the time, and I think one of my books, which people accuse me of trying to promote, which I never promoted, they're all the proceeds from books go to charity, and they always have. In there, I try to be very clear, at least in one of the prefaces, I can't remember which book, I said, a chartist is a chart artist. And if you rely upon charts and solely charts in your interpretation, you're going to fail. I mean, there's really three levels of chart analysis, I call it, rather than chart artistry. It's the basic level a lot of people look at is looking at a chart, examining it, and draw a conclusion. It's totally subjective. And I think their conclusions are a lot of time the result of their predilection or whatever their outlook is on the economy or how they feel that morning, the indigestion. If you showed a person, the best test is to show a person a chart today in the same chart with no label on it a month from now and see if they draw the same conclusion, because very likely they won't. They'll contradict each other. I went through a process like that at the Chicago Mercantile Board of Trade. There were like 1,000 traders there. And I said, this when the S&Ps were trading in obviously at the Chicago Merc. I said, here's a chart, and I selected 6 people. I said, what do you guys use? Most people said trend lines. I said, draw your trend lines. And every one of the 6 traders drew them differently. There's no consistency. And what I try to do, for example, on a trend line, most people draw from right to left. They take from left to right. They take a point way on the left-hand side of the chart and connect it with a current point, which they shouldn't be doing. They're supply points where there's highs surrounded by lower highs. You take the 2 most recent and connect those. So when I say you're almost connecting a trend line from right to left, taking the 2 most recent peaks, because the market really does exist in harmony, the movement below a trend line, once you break it, gets reflected above the trend line. You can formulate price objectives that way. But what I was trying to say, the level that most people are charged to operate on is guessing. Mm-hmm. They don't want to call it that. The next level is using indicators. And you use indicators to formulate conclusions, and you test those indicators. The third level is creating systems. And all my work is on the indicator level. So it's important if someone's getting into technical analysis, and like I said, I call myself a market timer because fundamentals are critical. But yeah, I try to time the market, and I try to identify exhaustion. Because usually if you buy into a low, you can always bail yourself out. If you buy into strength, you're sacrificing or forfeiting slippage, competition, and the potential of a market making a top at that time. So,
what do you think of? Because you mentioned this early on when we first started talking. You said, well, Mike, a lot of my work is coming from a price driven and technically driven, but different than some of the things that exist in your world. What do you think of the pure price action, trend following guys, the reactive strategies, the Bill Dunns, the David Hardings, the many of the turtles? What do you think of those types of strategies?
Well, I've done a lot of research there, and I think if you've got a portfolio, a large portfolio, they work very well, because at one time or another, a group of these stocks are going to be trending, and they will bail out those instances in which the other, let's say 34% of the time, what I found, 32 to 34% of the time, you'll be correct on a trend. Obviously I did a lot of testing on the turtle work, and Eckhart and Dennis and other people. Bill Dunn's been around forever, and John Henry had been around for a long time, but they all trend following. There's obviously great potential there. But like I said, unless you are able to build a large portfolio, eventually you're going to get caught. What I found is if you have world commodities, a lot of times they will offset a domestic commodity. I mean, copper, silver, gold, could trend, and the domestic commodities move sideways or go down, go reverse. One thing I did find, though, if you can use these conventional approaches, but you adapt them in the sense like, if you use the turtle approach, which you're very familiar with, I'm sure you tested, if you take a 40-day high and you exceed that high and you go long, for example, and then you're offset by a 40-day low where the low is less than the prior 40 days lows, that'll work, like I said, 32, 34% of the time. But if you introduce just one variable, and that one variable being, I'm a firm believer that markets, traders are driven by human nature. If yesterday is an up close, they believe today is going to be up close, and they're slow to admit that they're wrong. So if yesterday was an up close, they'll buy today, and they won't submit to the market until the close. So if the market's down, they'll wait intraday, they'll wait for the close, and then exit their trade, and they won't go short till tomorrow. So if you use that approach to analysis, if you're at a high prospectively tomorrow, your high is above the prior 40 days highs, or your close, whatever adaptation you use of turtle method. If you introduce just this one variable, I'm convinced you could probably enhance the results by 30%. And I mean that 30%, raw 30%. From 34 to maybe 64. And I've tested it. I haven't done it in recent years because I'm not a trend follower. But if the day before and you record that 40-day high or high close is a down close, your chance of being successful in that trend is enhanced the next day, because people are going to be skeptical and they're not going to go long until the next day because they are going to. If you're up the day before the 40-day high, the people who are going to buy are already in. They're anticipating it. So what's going to move the market above the 40-day high and continue the uptrend? The people have already bought. So it's more than likely it's going to be a false breakout. Do you understand what I'm saying?
Yeah, and I think what's nice about what you're saying there is it gets people thinking. I think you're taking people down the path of like, hey, if you're going to build a system, if you're going to establish rules, here's the kind of investigative homework that you need to do when you're looking at the price action.
Yeah, look what's happening the day before. If everybody's believing something, they're already in it. And who's going to be responsible for moving it through it? Because no other buying is going to exist. And a lot of times, you'll do just the reverse. What I do for everything, for my TD lines, I call them trend lines, for moving average breakouts, for new highs, new lows. If the bar before a breakout, whether it's a 1 minute, daily, weekly, whatever, is a down close, an upside breakout, it's more likely to be a legitimate breakout if the day before the breakout is a down close, the day before an upside breakout, and that includes with the turtle system, or turtle approach. If the day before is an up close, the wise guys are already in the market, and the chance of it perpetuating the next day and on is less likely because the buying pressure is already exhausted. So you almost do the reverse. If you have an up close day before a 40-day breakout, you can almost sell that. And
like I said, I think the big thing for the audience right there is just is not necessarily the tip that you're giving them or the thought or the particular idea about how to make a modification of this particular indicator, but I think it's more your thought process. That the idea of like think about what's going on and look at it from that standpoint. I think that's if people are really paying attention, I think that's what's fun about the way you're explaining that.
That really is important to look at things at the pedestrian level, and then take it. What would improve it? And that's what my whole career has been. That take something that's worthwhile, and people accept, and then make an enhancement to it or some improvements, and they're usually pretty. It turns out to be make whatever the approach was more successful. So
where Tom, if people can. Obviously, they can throw your name into Google and they can find everything there is about you really fast. But if you had to give people a location to maybe investigate more of your work, find out more about you, where would you direct them to?
To be honest with you, I really don't promote anything. That's what I think is.
I love it. You're the first person that said that here in 100 plus episodes. So, well, then I will leave it. I will leave it this way. If people want to investigate, and I'm sure they will, if they want to investigate more about you and your work, they can go to Amazon. A quick search is going to bring up more, and they could go to Google, and a quick search is going to bring up more, and they can dig in, and they should dig in and examine more of your thoughts and all of your work.
Well, I just want to tell you this, Mike. I've read so much about you in the past. I've always wanted to meet you, and I know you do a lot of great work, and I think what you're doing now is great, too. I mean, giving people, especially beginners and people who have been involved in the markets for a period of time, letting them see what's out there and what the potential, what the hurdles are to be overcome and what they're up against. It's pretty formidable. I would recommend highly people do a very thorough research people's backgrounds and things like that. And I'd always be skeptical if anybody's trying to sell anything.
Well, and I'm sure you would say this too, is that like whether it's anybody's background, the personal background of an individual is one thing, but then I'm sure you would say, hey, look, you can vet Tom DeMark, but it's probably even more important to vet your work.
That's right.
I mean, and that's that's the critical issue.
What you certainly don't want to do is buy a black box too. Because you don't know what you're getting. And I think these seminars and places like that, you always got to look underneath the hood and say, what are they trying to sell? And you just got to be careful. And I think what you're doing is giving everybody a forum, and people can evaluate it, which is great. That really is the market. I mean, the marketplace requires more people like you.
Well, I think some people were surprised, and I know even at the beginning of our conversation, you said something about, well, it might go counter to what I'm doing, but I've kind of stumbled into this that I enjoy. Of course, I enjoy doing what I do in my particular space of the industry, but I have like almost like a Charlie Rose type thing. I enjoy just putting my interview cap on and saying, hit me, because I'm just I'm the person out there that's saying, Tom, educate me too. I'm just here to listen and learn as well. And that's all I'm trying to do. I did it with Larry. I do it with all my guests, is to try, hey, teach me something. I'm just somebody that I want to learn something new.
Well, I'm sorry. I'd love to go over my concepts because I think they're worthwhile, but I'm sure a lot of people think it's, I'm passionate about it and I believe it's really helpful. And what I've tried to do, I think you look back over my career, I've tried to share what I've developed. I think that's important to share because I've gone down that path. I've been on the institutional side, the retail side, and I don't think anybody else has ever had that opportunity. And I've met a lot of these people. I'm not saying I'm smarter. I'm definitely not. But I'm focused and I'm obsessive and passionate about my work, and I believe in it. And I think that's important. If you can find people like that and work and enhance their work and make improvements, I think people should be successful. You don't want to have somebody who's superficially knowledgeable in many areas.
Well, Tom, I appreciate it, and we will talk again soon.
Thank you very much.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.